Good morning, everyone, and welcome to the Sensa Edge, where we break down market strategies and how to trade them efficiently. Today, we are talking about VIX, Wall Street's so-called fear gauge, the thing that spikes when the traders panic, dips when they are feeling comfy, and is constantly misunderstood. So, what is it? Why does it matter? And can you actually trade it? Let's break it down. Again, this is Zoe Beer from Sensa Edge. Thank you for joining in. What is VIX? The VIX, or the CBOE Volatility Index, is a measure of expected volatility in the S&P 500, the aka SPX, for the next 30 days. Notice I said expected volatility. The VIX doesn't measure what the market has done, it measures what option traders think it will do. It's built using implied volatility from a bunch of SPX options, specifically those with about a month to expire. That means VIX isn't looking at the past, it's looking forward, trying to guess how crazy things might get. The higher the VIX, the more uncertainty or a fear there is in the market. Think of it like a weather forecast. The VIX of 12, clear, light blue skies, breeze, which is good. The VIX of 40, category 5 hurricane, with a chance of brown underwear. VIX 60, change of margin calls. VIX 80, the entire financial system is collapsing. VIX 100, short USD, long beans and ammo. Let's jump in. Implied volatility. Why it matters. To understand the VIX, you got to understand implied volatility. IV is baked into every options price. Let me bring up my screen as I speak there. Again, CBOE, VIX, again, coming into the Yahoo Finance. IV here is baked into every option price. It's basically the market's best guess at how much an asset will move before the expiration. When traders expect big moves, IV or a price of option goes up. When they expect a snooze fest, IV or a price of option goes down. Since the VIX is derived from the SPX option, it's basically an index of a market-wide IV. If option traders are jittery, the VIX climb. If they chill, it sinks. And here's the kicker. When the VIX is low, it doesn't mean the market is guaranteed to stay calm. It just means traders think it will, and the traders are wrong all the time. Like literally all the time. If you listen carefully before, you realize the VIX is a derivative of options, a derivative of the SPX, a derivative of S&P 500. That means that VIX options is a derivative of a derivative of a derivative of a derivative of 500 different things. Fun, right? VIX levels to watch. So again, what numbers actually matter? Historically, the VIX tends to hang around 15 to 20, which is like the normal conditions. Under the 15, market feeling comfy, maybe even too comfy. A low VIX can signal complacency, which sometimes precedes a surprise move. 20-30, that's typical uncertain but not unhinged range. Over 30, we are in a stress mode. High volatility, big swings, and probably a whole lot of financial news taking about unprecedented times. Over 40, something seriously wrong. That's 2008 COVID crash or some other market-wide meltdown. Over 50, probably a volatility, even of some kind. Over 60, this is holy hell territory. If VIX is 60, we are well past something is seriously wrong in the territory. Again, like you go over 70, it's extremely temporary and indicates derivative spikes within the chaos. Over 80, sell volatility as much as you can and get your hands on. The VIX 80 plus lasts a very short period of time and options are insanely overpriced. Usually it's absurd. Do you know what? VIX has at 80 plus 4 times in the last 20 years, 4 consecutive days during the financial crisis in 2008, and 4 days during the early COVID to 2020. Again, the VIX isn't a perfect crystal ball, but when it spikes, traders take notice, and when it stays low for too long, smart money start watching for the next storm. Can you trade VIX? That's $1 million question, right? The short answer is no. Can you actually trade VIX? Short answer, again, you can't drive the odometer, you can't trade the VIX. Long answer, you can trade things that track VIX, but you can't trade the index itself. The VIX is a calculation, not a stock, not an ETF. Again, as I come into the sensor market here, you can directly go and look for SPX here, but you can look at a few other volatility like the ETFs and the ETNs like VXS here or UVXY, which you can certainly go and then jump into that particular thing. And you can see that. Again, you can try to mirror the VIX movement using a mix of future contract, and that's what this thing's VXS does. But here's the problem: these products don't perfectly track the VIX. In fact, thanks to Contango future term, look it up if you are a masochist, they tend to decay over time. If you hold them too long, you're basically watching your money slowly evaporate. It's a lot of small losses with the occasional big winner thrown in there. It's like a Auburn football season. So you can make money trading VIX related products, sure, but you can need to know what you're doing, and you need to respect that these instruments are not the same as the VIX itself. Again, you might ask, what's the final things here? So there you have it. VIX isn't some magic fear meter. It's just a measure of expected volatility based on the index. It can signal when traders are too complacent or too panicked. While you can trade it directly, there are plenty of ways to get on volatility. If you know what you're doing, if you're hell-bent on trading this VIX, SPX, if you can go into this, again, SensaMarket, I open the tab here. I can jump into the straddle, long straddle. I can choose SPY or SPX. If you want to really trade, SPY or SPX straddles are the cleanest way to do it. So let me show you how. Again, SensaMarket straddles, picked up the SPY here. If IV is implying a move in one of the direction or another, if you think this is overstated, you might want to short a straddle. So straddle is nothing but you are selling a put and selling a call at the same strike price, and that means it remains within this particular range. And then you are making a strategy that it's going to lie between, in this case, 571 to 559, and that's where the profit lies. Anything under or anything over there is the maximum loss. If you think it's the other way, you can do a long straddle. That means, again, you are buying a call and buying a put at the same strike price. I can change the expiration date. That means you are betting that it's going to go in either direction. That means it's going to go low, below 571 or above 596. That's the long straddle. Again, if you think that number is understated, you'd want to buy straddles. Remember, selling straddles is an unlimited risk trade. And remember, when the VIX is low, let me bring myself here. VIX is low, be cautious. When the VIX is high, be extra cautious. Again, thanks for listening in. Hope this was a good session, and be sure to subscribe, leave a review, and follow us on the platform. Thank you all. See you all next time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.